into Market Takes. It's a live stream for the Wall Street Journal. I am Dion Rabouin, markets reporter at the Wall Street Journal. If you are a long investor on the stock market, if you are someone betting that stock prices are going to rise, it's a rough Monday to start the week after a rough 5-week stretch for you where we have really just seen nothing but red across the stock market. That's the Dow, the S&P 500, the NASDAQ, the Russell. Everywhere you look, you're seeing selling. And that could be coming to an end this week. We've got some data that could put a positive spin on the market and really give investors something to be excited about and a reason to buy. Or it could give investors more reasons to sell, continue, or even worsen the sell-off that we're seeing right now this morning, and that we have seen, like I said, for 5 straight weeks on the S&P 500, for 6 straight weeks on the Dow. So want to get into all that. We're going to talk about what's making the market move, why we're seeing this massive sell-off across the stock market. We're also going to talk about the 2 big reports that we've got coming this week. That's the Consumer Price Index and the Producer Price Index. Basically, how much prices are increasing for businesses and how much they're increasing for consumers. You and I, how much more we're spending every time we go to the store, pay rent, go to the pump, all that good and not so good in the last few months stuff. So let's talk about the market. Let's talk about what we're seeing that's got us here on this day where we are down. Checking in on WSJ.com. The NASDAQ still down about 2.7% today, Monday, May 9th, 2022. You're seeing the Dow is only down about 1.15% and the S&P right in between, down about 2% today. That continues a sell-off that we saw last week. That was 5 straight weeks. That is the longest sell-off. That is the longest weekly consecutive sell-off streak for the S&P 500 in more than 10 years. The last time we saw selling like this was June 2011. So we're talking about more than 10 years. The Dow is down almost 10%, the S&P 500 is down almost 10% in those 5 weeks. Year to date, down about 14%. Put that in context, we again reached correction territory. Last week, the S&P 500 officially in a correction. So we're having a market correction. The NASDAQ, though, doing even worse. It has wiped away all of its gains from 2021 and obviously from 2022. We are now down to those levels where last we were sitting in November of 2020. So again, you're seeing a long-term 5 weeks now sell-off in the market, wiping away those gains from all of 2021, which was a pretty strong year on the S&P 500. So I want to thank you all again for tuning into the live stream. We're talking markets, we're talking CPI, PPI, those big inflation reports that we've got coming out this week. And I'm going to tell you why those could turn this thing around, maybe get some buyers back in the market, or could potentially aggravate the selling, make it even worse. And remember, we're now in May. We are coming off an April that was an April to forget for stock long-term or long stock investors. The worst month we had since March 2020. If you remember March 2020, things were not good at all. The NASDAQ lost 13% just in the month of April. That was its worst month since October 2008. The worst April the NASDAQ has had since 2000. Again, this is all really going back to yields on the Treasury market. The 2-year Treasury note yield went up by almost 200 basis points, 197 basis points on the 2-year. On the 10-year, 163 basis points. If you aren't familiar with the U.S. Treasury market, you don't watch it, just know that that is huge. The worst start to a year that we have ever seen in the Treasury and in the bond market. So a real magnitude shifting change that we're seeing across the bond market and especially in those U.S. Treasury markets, which is government debt. That's a big, big deal. And we're seeing that kind of continue into the start of May. Today, yields are down a little bit, but definitely a consistent theme that we have seen. Treasury yields going up, which means prices are going down, stock prices going down along with them. Also, so we're going to talk about CPI and PPI, but I want to tell you about the sneaky important report to watch this week, and that is the import-export prices that we're going to get on Friday. Definitely something to keep your eye on, and I think that's going to be a report that doesn't get a lot of hype going into it, but definitely one to watch because when we got that US GDP report, which was negative for the first quarter, a big part of that was the increase in imports here in the US. And, we didn't see a commensurate increase in exports. We just saw the things that we're buying from overseas. That's what sinks US GDP. I'm going to break that down and get into that a little bit later on. So look, all this goes back to the Federal Reserve, right? They had their meeting, their May meeting last week. Fed Chair Jerome Powell said that a 75 basis point rate hike wasn't on the table. Essentially, that means that they'd be raising rates by 3 times the typical level. So going 3 times as fast on the rate hikes as they typically do. He said that's really not on the table. It's not something we're actively considering. The market took a lot of joy and excitement from that, but it was just one day. So Wednesday, we saw the stocks shoot up. I think the S&P 500 ended the day up about 2%. The NASDAQ up more than that, 2.5% to 3%. Stocks just really jumping in a sort of fit of euphoria. And the very next day, Thursday, we saw that sell-off continue. We saw that again on Friday, and it looks like we're seeing it again today. It looks like investors are saying, yeah, okay, maybe a 75-point rate hike isn't on the table, as in 3 times as high. But if you're still going to be hiking twice as fast at multiple meetings, as you did in May, Fed raised rates by 50 basis points, again, 2 times as fast as normal. If you're going to be doing that in May and June and July, potentially out to September, well, you're still raising rates at a super fast pace. You're still going at an accelerated clip. And that's likely to weigh on the economy and weigh on a lot of these companies that have borrowed a lot of money. Look, the big picture when you step back and look at it is companies, especially a lot of these high-flying tech companies, they've borrowed a lot of money and they don't have a lot of profits. A lot of them are what you call zombie companies, which means they don't even make enough in profit to to make the payments on the debt that they have. So when you can't make your payments on the debt, that means you go into default, and the creditors and the vultures, they come in and they start taking what they can have and what they can get. So that's the situation a lot of these high-flying tech companies are in, and a lot of folks in the market are saying, this isn't looking good. Rates are just going to keep going up. Inflation's going to stay high for a while. That's going to mean you, Mr. High-Flying Tech Company CEO, are going to be in a pickle, and we don't want to own your stock. So that was big because Powell said, okay, no 75 basis point rate hike, but we still are going to do what we need to do to get inflation under control. Now, one big piece from that press conference, I don't think got as much attention as it should have, was Fed Chair Powell has been saying, we think we can engineer a soft landing. We think that we can, rein rates in without doing a lot of damage to the economy, without doing a lot of damage to the labor market. We're going to have a soft landing. Well, at the last meeting during the press conference, he said, no, a soft-ish landing. We might have a soft or soft-ish. And I think that soft-ish is what's got a lot of folks on edge, because now the Fed is supposed to convey confidence to the market. The Fed is supposed to say, hey, we've got everything under control. Everything's all good. Guys, just settle down. Let us handle this. Now they're saying, well, maybe we won't. And just before that, you had 3 former Federal Reserve presidents, one from the New York Fed, very important, Mr. Bill Dudley, also from the Richmond Fed, also from the Philly Fed, saying, we don't think there's going to be a soft landing. It would be very hard, if not impossible. The words Mr. Dudley used were next to impossible to actually have this soft landing, which means likely a recession, which means likely a lot of economic pain. So that all happened on Wednesday, and we've seen the market reaction since then to what the Federal Reserve has said. So that leads us into what we've got coming up next here on the live stream. And again, thank you all for tuning in. We talked about the market response, the market reaction, and we talked about what happened at that Fed meeting last week. Now we're going to look ahead to this week when we get CPI, the Consumer Price Index, and why that matters. So if you remember, the CPI for March was 8.5%, 8.5%. That's the highest we've seen in about 40 years. So the Fed is saying we're not going to do this 75 basis point increase, but we're still going to be raising rates. We're going to be dependent on inflation. Well, if inflation picks up and comes in higher than expected, right now the expectation is for CPI to reach about 8%, 8.1%, according to economists that have been surveyed and have been tracked by FactSet. If we come in lower than that, well, things are all good. It means inflation's slowing down. We're hitting that peak that the Fed has been calling for and saying that we're going to get, that most economists expect. But if it comes in higher, if it comes in especially above that 8.5% number that we got in March, well, that means the economy is in big trouble, that inflation is not only stickier, but it's rising continually. And the Fed is going to have to do more. That means Another 75 basis point rate hike could definitely be on the table, and we could be talking about 1 full percentage point, as in raising rates by 1%. That would be really big. Now, economists think that we've hit the peak of inflation because the month-over-month increase on core inflation, when you strip out volatile food, volatile energy prices, which tend to move a lot, when they just look at what's, housing, prices for consumer goods, things like that, that rate is slowing down. And generally it's peaking out. The other thing is that the comparisons to where inflation was back in April of 2021, well, it was a lot higher than it was in March and in February and in January. So you saw that pickup in inflation start to rise at a rapid clip last year around this time. And so you're dealing with higher inflation and you're comparing yourselves to a higher number. So that's why economists are partially expecting those two things, or why economists are expecting inflation is going to cool down, or at least the rate of increase is going to start to cool down as we move throughout this year. If that doesn't happen, definitely look for some big headlines and some big moves in the stock market. Now, we also get the producer price index. That's coming out on Thursday. CPI is on Wednesday, 8:30 a.m. I think that's going to be must-see TV. So be there or be a... On Thursday, we get the PPI, the Producer Price Index report. That's not as heavily followed, but in March, we got a record high, and we've seen producer prices lead consumer prices as businesses have continued to be able to raise rates as their costs rise. So they're passing those costs on to consumers. And we also have seen if these problems for businesses continue in terms of hiring, in terms of on the labor front, having to pay more for wages, having to pay more for commodities, all the inputs they need, they're passing those on to consumers. So will we see producer prices continue, and will we see that lead continue where, when producer prices go up this much, consumer prices seem to go up that much as well? That's a big question. What we saw from the jobs report on Friday suggests that businesses are still having some trouble. We saw in the JOLTS report on Tuesday, job openings in March were a record high again, but you saw less hires. So more job openings, less people being hired for those jobs. You saw a new record for quits, meaning the Great Resignation, maybe that's still continuing, still going on. Is that going to factor into business costs being increased? You did see on the jobs report that we got on Friday that average hourly earnings number kind of start to come down a little bit, but average hourly earnings year over year still about 5.5%. That's still very high, and it's something that the it's something that the Federal Reserve and lots of other economists have pointed to as a reason why higher inflation might stick around, because those labor costs are stickier. Think about it. If you got a 5.5% raise this year, you're not going to want a 3% raise next year. Or if you switch jobs and you were making, 5.5 times what you were making at your previous job, well, to go to another job, you're going to want an even bigger raise. So those labor costs tend to be sticky, and that's a reason that economists worry about these numbers that we saw in the jobs report on Friday. Again, PPI, the Producer Price Index, hit a record high in March. Producer prices for businesses were up by more than 11% in March year over year. That is a big number, and if that continues to spring higher, it's going to be hard for those consumer prices to come down, because businesses and companies have inflation on their side. When consumers see prices going up everywhere, well, it's easier for businesses to raise their prices, and that feeds into this kind of vicious cycle that we start to see. Now, that's PPI and CPI. Those are the big numbers. I think those are going to be the big market movers this week. No question about it. But if you're someone who is, keen to watch what's really going on in the economy, what's going on underneath the covers a little bit, I urge you to look at this import and export prices report that we get on Friday. A big part of the negative GDP report that we got for the first quarter was the fact that we had so many more imports. The imports that we were getting were more expensive, and we bought more of them. A lot of that is just because US consumers are spending more, but most imports are fairly cheap. That's why we import things, because it's cheaper than what we can make here. So if people are buying a lot of imports, it means they're buying a lot of cheap products. The people who are buying those cheap products, generally the lower income folks at the lower end of the income scale. And when they're doing a lot of buying, well, that means that they're trying to save money usually. If you've got a lot of folks saving money, trying to save money at least, buying cheaper things, well, usually that's a sign that things in the economy not so great. So definitely keep a look for that import-export price number on Friday. We also get the University of Michigan's Consumer Sentiment Index. Look out for that because, again, we've been at the lowest rate in about 10 years. All year this year, numbers picked up a little bit in April, but is that going to continue? Will we see continued increase, or will things go back to being worse? Are consumers really just starting to throw in the towel on buying? So I want to thank you again for tuning into Market Takes. Dion Rabouin from the Wall Street Journal here with you. If you're watching for your first time, thank you, and I hope you'll be with us again next Monday. If you're a regular viewer, appreciate you tuning in again. And we will be back, like I said, next Monday to do this all again. We talked about the stock market sell-off. We talked about what you need to watch this week, CPI and PPI. Also, those import and export prices, I think, are going to be a very big deal this week, especially if you're on recession watch, like I know a lot of folks are. So thanks for being with us here on Market Takes, and we'll see